You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody, that music means we are back for a double episode whammy here today of Education Wednesday. Yes, it's time for a twofer, a two-parter of Options Bootcamp. For all of you Secret Club folks, you get it live in your ear holes right now, back to back. No waiting for the rest of you. Episode 2, you don't have to wait a week out there for all you on-demand folks. So if you want to get that stuff in your ear holes, you want to join us live, you want to ask questions live, you want to participate in great pro Q&As. Man, did we go deep on the pro Q&A yesterday. And in an interesting direction as well. We went from volatility in Ukraine all the way to Hall of Fame, easy for me to say, blackjack strategy and how you can apply your trading analysis to pro-level blackjack with a noted author, vol trader, and Blackjack Hall of Famer, Mr. Don Schlesinger, our good buddy, who's created a lot of what is now in the modern vernacular of blackjack, like things like hand scoring and the illustrious 18, all these modern concepts of blackjack he created, hence his Hall of Fame designation. Also, spent a little time trading short vol for Morgan Stanley over the years. He's infamous for saying an option should be sold or not sold, never bought. And right now, given how high vol is, he's very much in the not sold category, which is kind of intriguing. You want to hear that? You want to check out Options Oddities, all the other exclusive stuff. In fact, they're packing up, our producers are packing up some of our pro trading crates to go out to all of our winners right now as we speak, listeners. So you want to get on those giveaways as well. All that journey begins at theoptionsinsider.com/secret club. That's the only thing you got to do is click on over there, click on that I want to play along button, and you too can join the party. That is the secret club. Of course, if you're listening on demand, as I know a lot of you do, and if you like what you hear, keep rating and reviewing. I know some of you are going all the way back to the dark days of the show, the very early day, which we love. I haven't listened to those episodes in quite some time. Maybe I should, given some of your questions and comments that are coming in about the early episodes of the show. We'll get to that a little bit later. But if you like what you hear, keep rating and reviewing. It does help all of the new listeners. They are legion. They are plentiful. They need your help. Leave a 5-star review if you like what you hear. If you think 4.5 because of Dan, I get it. You know, he's the black-headed one. We call him that for a reason. Just leave your feedback there. And, of course, your questions and comments. We do love to hear from all of you folks out there. And speaking of the black-hatted one himself, a.k.a. Mr. 4.5 stars, Mr. Dan Passarelli from Market Taker Mentoring joins me once again. Mr. P, welcome back to the show. How goes it, sir?
Oh, it's going pretty well. I can't complain. 4.5 stars out of 4 stars. Wow.
Oh, yes. You have exceeded the scale once again. I didn't know your mom created the scale. How nice of her. Did she tell you it was a 4-star scale when you were a little kid? Dan, you're 4.5 stars out of 4. That sounds like something a mom would say.
Everybody gets a ribbon.
Everyone wins a trophy. All right. Speaking of reviews and fun stuff, before we dive into today's mega volatility extravaganza, let's give you an example of one of those 5-star reviews. our producers didn't put where this one is from. This one is a 5-star review from Eli. It's on one of the many on-demand platforms that we are available on. And Eli says, 5 stars. I'm not sure what you're waiting for. These guys are the best. Subscribe today. You won't be sorry. You know what? Thank you for those kind words, Eli. They're direct. You're succinct, right to the point. You get to the good stuff right away. We appreciate that. So if you agree with Eli, leave that review wherever you find this program. As we keep on rolling, it is time to commence the volatility barrage. It is time for your basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in. Prepare to learn. Yes, sir.
All right, everybody. Let's do it. Mr. Dan, this comes on the heels of what you actually suggested on our last episode. You thought it would be a good time to do a bit of a deep dive into volatility and the VIX and everything that makes up that crazy trading volatility ecosystem right now. And I think you were correct, Mr. Dan. I cannot think of a better time to talk about volatility and VIX than at a time when the market yesterday whipsawed for about 100 and plus points in the S&P from the trough to the peak and then right back down again. And then today we have markets rallying, S&P up 2.5%, NASDAQ up freaking 3.5%, vol all over the place. It was over 30. Let's see if we're still, given this movement, we should still be over 30, quite frankly, out there. But yeah, 32, still 32 and change out there. So Mr. Dan, I think you had a good suggestion. I think this is a good time to discuss vol. What do you say, sir?
I think it's always a good time to discuss vol, Marcus, but let's do it. Let's do it today. Today's better. Today is the first day of the rest of your life, man.
Yes, the first day of the rest of your vol trading life. So if you're hearing all this stuff, you're seeing all this stuff, you've been watching the news, watching the financial outlets, listening to shows like our network, and hearing things like VIX and other things bandied about, and you're like, what the heck are they talking about? We're going to cover all that today and a whole bunch more. So let's start there. Let's start there with the mother of them all, VIX. You probably heard that bandied about. You probably also heard it called the fear gauge, a pretty popular moniker. That moniker alone is in no small part responsible for the success of VIX. People started calling it that way back in the early days of the VIX, even before it was a tradable product. Yes, VIX has a long history. It's had many incarnations before it got to the product that you know and love or perhaps hate today. In fact, when Dan and I first walked on the floor of the CBOE, the VIX was a very different thing. It was a very abstract barometer of volatility. It wasn't even on an index most of you have heard of or trade. It wasn't on the S&P 500. It was on what was then the king of the volume over there at the CBOE, which was the OEX, a.k.a. the S&P 100. How many of you newcomers to the markets have even heard of the S&P 100? Probably not many of you, but that was the big dog. It's a little bit before my time that the OEX was the big dog. It was still trading pretty actively when I got on the floor back in 97, but already the S&P was starting to come on strong, and it was slowly expanding and growing and kind of taking the pole position out there. So you can see the first problem with that. What was the VIX in its inception? It was 30-day at-the-money volatility of the OEX, the S&P 100. So effectively, they took the straddle, the 30-day straddle of the S&P 100, and that's what VIX was. You couldn't trade it. It was just an abstract number that they disseminated to the world and called it the fear gauge. And you know what? That sounded really cool, but you couldn't really do anything with it. Dan, do you recall those heady days of when VIX was just an abstract, pretty much straddle from the OEX, sir?
Yeah, I do. I mean, people would kind of talk about it a little bit. And it was just sort of, this kind of thing that existed somewhat. Yeah, I remember that.
I remember even thinking back then, what's the big deal? I'd hear CNBC talk about it every now and then. They like to just call it the fear gauge, quite frankly. They just like saying that. What's the big deal? It's an abstract number. You can't do anything with it. It's kind of meaningless, really. And so it kind of remained that way for some time until the early 2000s. That's when SIBO realized, they had something on their hands with this whole fair gauge thing, but it wasn't really that relevant to the modern trading landscape. So the first thing they did was they revamped it. They took it off of the S&P 100, a product and index most people have never heard of, and moved it onto one just about everyone's heard of called the S&P 500. So now you've gone from the 30-day straddle on the OEX to the 30-day at-the-money straddle on the SPX. Already you've made a huge leap forward in terms of understanding, in terms of usability, in terms of viability and relevance for most of your audience out there. But they didn't stop there. They did something else. They added a tweak to it, which is still a little bit contentious to this day, and we'll get to that. They added, because there is more information than just the at-the-money straddle. The at-the-money straddle, if you go out and map that across a product, that will give you your at-the-money term structure to it. But what else do we talk about here on the show all the time? We talk about volatility skew. And SIBO knew that back when they revamped VIX back in the early 2000s. So they incorporated that into the measurement and the methodology for VIX. They incorporated out-of-the-money puts and they incorporated out-of-the-money calls. So you get a sense of what's going on in the skew as well. So it's not just an at-the-money vol measure anymore. It has a little bit more moving parts to it. And that is what has become a more modern incarnation of VIX. They've made tweaks to it since then, but that's effectively the modern VIX that we know and love today. But even still, back then, it still was just an abstract index that they disseminated. You couldn't do anything with it. Okay, the VIX is 30. All right, the VIX is 12. Okay, can't do anything with that. It was just an indicator and nothing else. And so SIBO decided, you know what? We should probably do something with this. I remember this, Dan. Options Insider did not yet exist. I had left the trading floor, and I was doing a bunch of other stuff. I was trading upstairs and doing a bunch of other things. I had a column in Traders Magazine. I was writing about options trade. I was one of the few people really back then writing about options. I mean, it was kind of me and striking price was kind of about it. And so I went over there to SIBO back at that time, and I was talking to Bill Brodsky, who was the CEO. He told me back then in 2004, they're going to launch VIX futures. And I remember just looking at him and thinking they were crazy people. I was like, who's going to trade this thing? I was a former SPX trader, right? So I inherently knew what VIX was. It was effectively S&P vol. First off, who's going to want to make markets in this thing? Because you're effectively going to be a layoff product for all the rest of the market makers out there who have vol risk in the S&P. They're going to come and look to you to hedge that away, and you're going to have all the risk of the pit on. And that was a huge stumbling block for a long time. No one wanted to make markets in this thing because they couldn't really come to grips with how do you make markets and effectively without blowing yourself out in effectively the vol of the S&P, which everyone else is out there buying and selling all day long in the S&P 500. It was a big challenge. But they launched the futures in March of 2004, which, Dan, think about that. That's crazy. That was 18 years ago. We're on the 18th anniversary of VIX futures. Does it seem like it's been that long?
In some ways, yeah. But in some ways, no, also. Yeah.
So I thought there were crazy people down there at the SIBO, and they told me they're going to make VIX a tradable product. I was like, okay, maybe the big institutions and the market-making firms will trade this as a hedge against their S&P vol exposure. But no retail is going to touch this with a 10-foot pole. And that's pretty much what happened. They launched these in March of 2004. So again, 18 years ago, almost exactly. And no one really wanted to touch these things with a 10-foot pole. The VIX futures languished for quite some time. Mr. Dan, you have a nugget you want to share with us about the early days of the launch, sir?
Yeah, it was pretty interesting. So there was a couple of things. First, when right around the time when they started, I ended up being able to participate in sort of like a focus group sort of thing, I guess. It was kind of informal. It was me and some of the guys at the SIBO who were creating it and marketing it. And then there was I want to say it was me and maybe Overby. I think Overby was there and a few other of us. And they brought us into the room and they're like, okay, here's what we're thinking about doing, with these VIX futures and options. I think it was options at the time, I forget if it's futures or options or both. And they kind of explained it and they were like, yeah, it's going to be the expected future value of the VIX at expiration. And I was just like, why are you doing it that way? and like the reason was, I didn't go through all the notes. I don't know if you had plans to talk about this later, but the reason why it's such a kind of weird expiration is because that's the only way that they thought that they could get it through, through the SEC in order to or FINRA or whatever, to launch products on it, to launch it, because otherwise they figured that it would be too easy to manipulate the settlement. And I just remember, and I still kind of feel that way a little bit. It's just like such a cockamamie underlying, and I kind of wish it was a little bit more clear. So funny, interesting story in the history of VIX derivatives.
Funny you get to manipulation. Well, we will get to that in a little bit, sir. There's a lot to touch on there. Before we roll off the futures, see what I did there? Roll, pun intended. So they launched in March 2004. Nobody really wanted to touch them. They're starting to do better now. But let's do a quick starting point there, because that's your first real tradable vol product out there. So what do you got now? What do you got out there? A lot of you don't like to trade futures. I get it. But if you want to understand VIX and VIX options, you kind of have to start with the future. So now, obviously, you have a couple of moving parts when you're talking about VIX. You have what's widely disseminated on places like CNBC and others. It's just the VIX index, also called the VIX cash. That's just the number I mentioned before. They take the S&P options, they run them through that formula. It takes the at-the-money 30-day straddle, includes the skew, a few other moving parts, and they come up with this kind of abstract number that they disseminate. And that's called the VIX. That's the VIX cash. Can you trade that? The answer is no. It would be nice if you could buy and sell the VIX cash. Many people have tried to come up with some sort of approximation of that. All of them have failed. It is a very challenging thing to try to replicate. So instead, what you can trade are the futures. And that's where we're getting to now. Obviously, futures, if you know anything about them, they trade in set expiration months. So there'll be a front month future, then there'll be another month out, and they'll go all the way out. And if you look at that as a chart or a graph, that's what's known as the term structure of that future. This applies to all futures you're going to trade, not just VIX futures. Oil futures, a big issue right now. Natural gas, gold, pick your commodity. All those futures term structures are kind of in flux. But what you traditionally see, and it's also the case in VIX futures, and again, these are kind of wonky terms, so bear with me. I did not create them. But you see a setup called Contango, which means effectively that the nearer term futures are going to trade at a lower price level than the longer term future. So the farther out you go along that term structure, you should see an upward sloping chart as the prices tend to go up for a variety of reasons: uncertainty, cost of carry, all these other factors that play along into the longer term price of various assets, whatever they are. And so VIX usually trades in that type of scenario, and that's where the futures usually trade, except for times like right now where things are a little hairy, a little crazy. When VIX is moving around multiple points in the day, the S&P is swinging 100 points at a clip. Now, these are not normal days, listeners. So in times like right now, we see VIX exhibiting a different setup called backwardation. Again, don't blame me. Didn't coin the terms. I know they're terrible, but hey, let's just work through them together. What that means, of course, is when the narrow dated contracts, so the front month, 2 months out, those are trading at higher price levels than the longer term contracts. And that's when things get wild. That's when things get hairy. That's when you need to pay attention, and when the little hairs on the back of your neck should be standing up. In fact, I pulled this from right before showtime to give you a bit of a real life example. As of the start of the show, VIX cash was at a 31.87, so just shy of 32. And the front March future, so the front future in VIX options, was trading at about 31.25, so a little bit below the cash. And then the April future was at 30.62, so both of those pretty lofty. If you go out longer term on the term structure all the way to the, let's say, November future, that's at a 26.82. So you're talking about a 4.5 point premium of the March future over the November future. That's a pretty hefty backwardation, listeners, which means that, hey, things are frothy. People don't really know what the heck is going on right now, and they're pricing that in to that near-term portion of the curve. It also means they don't expect that madness to last all the way to November. Otherwise, that future would be at a similar price level. So there's a lot of craziness right now. They don't really know what it is or exactly when it'll end, but they probably have a good sense that something is going to resolve itself in the next month or two out here. Mr. Dan, anything you want to add on those awful terms of backwardation or contango, or in general futures and futures trading?
Yeah, those words been around forever, man.
They definitely predate us, sir.
Yes, literally centuries. So yeah, they were doing some crazy stuff back then. Probably, smoking opium or taking Laudin or whatever it is they did back then. But I'll tell you what, you can get a lot of different information. Like, even if you are never going to trade VIX options or anything, like, there's a whole bunch of information that can be inferred from simply looking at the VIX term structure. It's super, super darn useful. It kind of gives you an idea of, what the market's thinking, and does the market expect more volatility in the future? Expect a resolution to the things causing volatility? It's super useful, even if you don't trade it.
I definitely agree with that, listeners. I've said this many times on our Volatility View show. And again, if you want more information on this topic, that's the show you should be checking out. But I've said it many times on that show that the answer to all of your volatility questions is lying somewhere there in the vol surface of the VIX futures, the VIX futures term structure. You just have to find it. It may not be that easy to find, but it's in there. If you want to know what people are pricing for a certain event or how things are looking at a certain perspective, it's all baked in there with real money. And it's just a question of digging it out and finding it. So if you can become a little bit more versed, a little bit more fluent in the language of VIX futures, it could certainly help you in your trading over the long term. Let's fast forward a little bit. The VIX futures kicked off, didn't really light the world on fire. It wasn't until a couple of years later, 2006, that SIBO launched the options on the VIX futures. Now we're talking. Now we're cooking with some gas. The combo of the options with the futures started feeding into itself. One product really driving volume in the other. And that's where people really started to sink their teeth into this. And we started to see really some traction with VIX and becoming this tradable product and really sinking into the mind share of your average everyday trader. Because now they could trade it for the first time, especially for a lot of options traders. Futures are still remain a relatively niche product for a lot of people out there, but the options a lot more far reaching out there. Again, same caveat applies. These options not priced off the VIX cash. So if you're saying, why is VIX cash at 20 and my options are still not moving? You have to look at where the futures are. So right now, those front options in VIX are going to be priced off of not the cash, which was 31.87 at the start of the show, but that front March future, which is 31.25. So if you're looking at your options prices, you need to take into account the value of the actual future and make sure you have the right future. It's sometimes easy if you're trading a little bit farther out in VIX options to look at the wrong future when you're pricing up your options. So make sure you have the right future in mind. Sounds very simple. It sounds very basic. You would not believe how many people have written to us over the years saying, hey, what's going on with this? And we find out, they were looking at the wrong future. And that's why they didn't understand what was going on. So make sure you have that down if you're going to be trading VIX options as well. Let's see, a couple other things to mention about VIX options here. Obviously, a very high volatility, high volume product right now. It can hit 1 million contracts. It has done so multiple times over the past few months as this volatility explosion has really kicked into high gear. Typically, in most scenarios, VIX is going to be a very call-dominated product because think about it, listeners. VIX tends to explode up and then drift down. So the options order flow is going to be designed to capture that. People are going to be loading up on calls, and that's primarily where the action is, except for times like right now. VIX is backward, VIX is high, and so we have seen lately and leading into the explosion recently, we did see a lot of puts dominating the tape out there. In fact, the top 10 size positions in VIX options for the better part of the past few months has been about 90-10 puts over calls. So interesting stuff out there. People were trying to fade the levels of vol that we had. I'd imagine this week, given what's been going on, probably a little bit more upside has crept in, but we'll have to wait till Friday to find out on Volatility Views. So at times like this, when the futures are backwards and we're seeing puts dominating the top 10 out there, these are kind of aberrant scenarios for VIX. You should be very cautious when diving in. Now, Dan, one of the questions we get a lot about VIX, and I'm sure you probably get this as well, is VIX a good hedge for my portfolio. Where do you fall on that one, sir?
Oh man. So it's somewhat of a good hedge. And I will trade it a little bit, but it's not a direct hedge. Like it's a hedge that works. I want to say the most recent data is something like 80% of the time or something. Like 80% of the time when the stock market goes down, VIX goes up. And like, can you imagine buying a car insurance policy and the deal you make is, hey, 4 out of 5 times, it's going to be fine. We're going to pay you. But 1 out of 5 times, you're on your own. Like, that's crazy. Like, so it's not really a great hedge. And especially if you're novice to it. Like, there are some people who are professionals who make a living out of doing it and kind of know the like extremely nuanced nuances. But for a typical person, you're so much better doing it a different way, just using a collar or something.
Yeah, people always ask me, what do I prefer, an S&P put or a VIX call as a hedge? And I always tend to correct them. I say, I don't really think of VIX as a hedge. I think of it more as a kicker, something you can add in your portfolio. That is a great thing to have at times like over the past couple of weeks where vol has exploded to the upside. That's when VIX really outperforms and when you want to have some positions in place. Outside of those scenarios, don't take my word for it. Go look at any study, and this has been done at any given RMC, which is the CBOE's risk management conference. On any given year, there's usually 2 or 3 papers and presentations on this exact topic, S&P puts versus VIX calls, and which one works better as a quote-unquote hedge. So I've sat through a lot of these presentations. I've looked at a lot of the numbers myself. And in most of these scenarios, the S&P put always outperforms. It's those few moments when VIX explodes that makes them end up pretty much sometimes rounding out to being equal. Kind of depends on the frame of reference. Of course, the caveat there is you have to have table stakes. You have to have skin in the game to capture that move. It's kind of like sitting at the blackjack table and keep playing until you can hit the blackjack. You have to be in the game to capture that moment. And so that's the challenge with VIX. You have to market timing, making sure you're in at that right moment. If you miss that moment, but you have VIX on the rest of the year, guess what? You're losing money. You're underperforming out there. So it's a challenging thing. If you want a direct hedge where you know exactly what you're getting, you buy a S&P 4,000 level put, for example, listeners, that expires in 3 months. Anytime between now and that 3 months, you can sell the S&P 500 at 4,000. That's a nice thing to have in your back pocket for a rainy day. Could be a little bit pricey. We've talked about ways to pay for that in the long history of this show, but you know exactly what you're getting. It's contractually guaranteed. No one could take that away from you. You have a delta, so you know exactly how much that put's going to move for a given move in the underlying. It's all very straightforward and understandable. The VIX, as Dan said, is very much a crapshoot. You don't know how much is going to pop on a given day. You don't know if your calls are really going to work or if they're not. If you have the right time frame on, there's a lot of moving parts to VIX. So is VIX a hedge? I don't think of it as that. I think of it as a kicker. If you want to add that in to really get some extra performance out of your portfolio in these down market times, then VIX can certainly do that. But is it a quote unquote hedge? No, I would not put it in that category. Now, the other thing I'm going to get to, Dan, and we're already kind of coming up against it. We've only kind of scratched the surface. I was going to try to do all the vol today. I'm not sure if we're going to be able to do it. Maybe we need to do episode 2, be part 2 of our vol extravaganzas. We got to get to VXX and UVXY, all this good stuff. But I want to touch on this before we wrap up, Dan. Something you brought up at the top of the show, which is VIX manipulation. This is probably something, if you type VIX into your Google browser, this is probably something that's going to come up somewhere on that page. There have been many lawsuits against the CBOE very recently, within the last few years, alleging this exact scenario, this exact phenomenon. Some of them accusing the CBOE of manipulating this, which is patently absurd. The notion that, Ed Tilly, the CEO, is down there with a lever in the basement of the CBOE, laughing maniacally and moving VIX hither and yon. That's what some people alleged, and that's absurd. And those cases were all thrown out. But some other ones, even the judges who dismissed them, pointed out to maybe there are some potential issues with the calculation that could be exploited. And what they're talking about, listeners, is effectively what I mentioned earlier. That first change they made when they incorporated the skew into the calculation. That is still what is bedeviling VIX to this day. I personally like that change. I think vol is more than just an at-the-money measure. Vol should incorporate some skew, but how you do that is open to interpretation. And so what SIBO did was they incorporated out-of-the-money call strikes and out-of-the-money put strikes. They stopped calculating them effectively when there really were no bids in them. So they didn't incorporate those. So what people found out very early on in the lifespan of VIX was, hey, if we start parking some bids and some otherwise worthless put options in the S&P 500, I'm talking far out of the money, things that are well beyond anything that should have a bid. And if they did that right before the expiration and settlement process, the VIX calculation would take those strikes into consideration, and they could effectively manipulate the VIX settlement. And that's what happened multiple times. There were many times going into settlement where large, mysterious prints were going up, and these far out of the money S&P 500 puts. And it was not a de minimis amount of money. You're talking hundreds of thousands of dollars being spent on otherwise worthless options. These people are not insane. They're not going to spend that money unless they got a commensurate payoff in the overall settlement. And so that's what people were alleging. Most of those lawsuits were tossed out, but the VIX does still have, I think, to put it charitably, some wonkiness around the expiration and settlement process. So my advice, and the advice of most of the people on our network addressing this, has been VIX is a great product to trade until you get to the settlement process. You don't want to be there when that happens because it is still a bit of a crapshoot riding that through settlement. You never really know what number is going to pop up, and they say, okay, here you go. That's your settlement number now. Your options settle out to this price, and it could be very different from what the futures were trading. So if you're trading VIX options, my warning, my caveat to you would be trade them, have a great time with them, take those positions off before expiration. You don't want to be subject to all the whims of the settlement process. Dan, I don't think you and I have ever really sat down and talked about this. What are your thoughts on all these allegations and charges that the VIX can be manipulated with these out-of-the-money puts? And what is your advice to traders to avoid that?
I think it's extremely unlikely because, yeah, I mean, you hit it on the head just to sort of piggyback off some of the stuff that you were talking about. I mean, like what you have to take into account is, first of all, the SPX is such a humongously liquid contract, and someone would have to have such a humongously gigantic position in VIX in order to make any money off it. And then they would have to trade SPX so big that they would have so much risk in that to be able to make money in VIX. Like, I don't know. It just seems extremely unlikely.
We'll have to leave that there for right now. All you Secret Club folks, though, don't worry. You're getting episode 2 in your ear holes right now. But Dan, for everybody else who has to wait a week, in the interim, if they want to go check out maybe your website to learn a little bit more about this stuff, where should they go? What should they do?
Well, you can always make your way on over to markettaker.com, and we'd love to hear from you. We always welcome our listeners from this podcast, and we're glad to help any way we can.
All right, that's Market Taker. Don't forget the second T.com is the place to go. Remember, if you want to deep dive into this stuff in a lot more detail as well, if you're just listening to this show, you should really be subscribed to our full network. That will get you our Volatility Views program. It airs every Friday on the network. It's been running for pretty much a decade plus as well. It's had a who's who of the best volatility minds on the planet on it over the years, and we discuss these issues in a lot more detail on that show. So check out that show if you haven't done so yet. That's going to do it for us. Remember, if you want to join us live, get episode 2, all the other fun stuff in your ear holes immediately, all the other goodness, theoptionsinsider.com/secret club. Otherwise, we'll see you back here next week for episode 2 of our great volatility extravaganza. Stay safe out there.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.